Have you ever noticed how a heartbeat monitor moves? Tight and calm, white when stressed. The market behaves the same way. It breathes. It expands and contracts. And that's exactly what a Bollinger Bands show you, how much the market is breathing. Bollinger Bands are a popular volatility indicator created by John Bollinger in 1980s. Their job is simple, but very powerful. They show when the price is stretched too far and when it's getting quiet before the next move. Technically, Bollinger Bands consist of three parts. The first one, a middle band, usually a 20-period simple moving average. The second, an upper band, the SMA plus 2 standard deviations. The third one, a lower band, the SMA minus 2 standard deviations. Don't worry if standard deviation sounds complicated. It simply measures how much price is moving away from its average. When the bands widen, volatility is high, the market is active and prices are moving fast. When the bands tighten, volatility is low, the market's quiet and consolidating. Think of it like an elastic band around price. When the market stretches too far, it tends to snap back. That's why Bollinger Bands help traders spot potential reversals or breakouts before they happen. Here's how traders read them. When price touches or breaks above the upper band, it's often considered overbought. The move might be running out of steam. When price touches or dips below the lower band, it's often oversold. The market might be ready to bounce. But here is the key. Just because price touches the band doesn't mean it will instantly reverse. In strong trends, price can walk the band for a long time, hugging it as momentum continues. Let's put it into a real-life example. Imagine Euro USD trading quietly between 1.0900 and 1.1000. The Bollinger Bands are tight, like a calm heartbeat. Then suddenly, price breaks out and the band expands fast. That's your clue that volatility is returning and the market might be starting a new trend. Now, let's look at the opposite. Suppose price has been trending up for days and now candles are pressing against the upper band while the RSI shows overbought conditions. That combination often warns that a pullback or short-term correction is near. Bollinger Bands can also help you identify squeezy setups, periods of extremely low volatility that often lead to explosive moves. When the bands get very close together, it's like a spring being compressed. The tighter it gets, the more energy it stores. And when it releases, the breakout can be huge. Think of it like watching clouds before a thunderstorm. Everything seems still, but you know the pressure is building. The breakout direction can go either way. So traders wait for confirmation, a candle closing outside the band with strong volume. Let's go step by step on how to use Bollinger Bands effectively. Identify the trend. If the middle band, the SMA, is sloping upward, the trend is up. If it's sloping downward, the trend is down. Watch the band width. Tight bands mean potential breakouts. Wide bands means high volatility, possibly overextension. Look for reactions. Price often revert towards the middle band after touching an extreme. Combine with other tools. Use RSI, MACD, or support resistance for confirmation. Here's a simple strategy many traders use. During a quiet period, bands close together. Draw key support and resistance levels. Wait for a breakout candle that closes beyond either band. Confirm with volume or momentum like MACD or RSI. Enter in the direction of the breakout and target the opposite side or next key level. But be careful, Bollinger Bands don't predict direction by themselves. They only measure how far and how fast price is moving. You still need to read context, structure, trend, and confluence. Let's make it more relatable. Think of the market like a heartbeat. When the bands are tight, the heart is calm, maybe resting. When they expand, the heart races, momentum surges. And just like the body can't sprint forever, the market eventually needs to rest, bringing the bands back together. So, to recap, Bollinger Bands are made of a moving average and two standard deviation lines. They show volatility, how active or quiet the market is. The tight band equals a cold market, potential breakouts. The wide bands equal a volatile market, possible pullback. They work best when combined with other tools for confirmation. So in short, Bollinger Bands don't tell you where the price will go. They tell you how far it's stretched. They are like the market's breathing pattern: inhale, exhale, expand, contract. If you can learn to read the rhythm, you'll start catching moves, not when they're obvious, but when they're about to begin. So remember, don't chase the noise, read the rhythm. Bollinger Bands help you feel the pulse of the market one breath at a time.